Hello and welcome to this special edition of Money, 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 Commonwealth Goals with CNBC TV18. Ahead of the start of the Commonwealth Games on the 28th of July, CNBC TV18 has undertaken a special mission of financial fitness. Just like the Games demand absolute physical fitness, similarly, for financial wellness too, one needs to stay prudent of one's financial fitness. Joining me in this endeavor today is Prableen Bajpai of FinFix Research and Analytics. And what are we talking about today? Well, just like when it comes to your physical fitness, a lot of people may have certain biases. Some may think that they have endurance, not speed. Some may think elsewise. Some people may want to walk and not run because they think they don't have the stamina. Some may despise going to the gym. But you know what? You can train your body to overcome these kind of doubts. Similarly, we have biases in our behavior. There are several behavioral traits which can lead us to, making poorer choices when it comes to our investments. It's not always the investments which go wrong. Sometimes it's the way we behave with them which can cause or lead to suboptimal performance of our portfolio. So what are these behavioral biases and how do you overcome them to maintain your financial fitness? That is the question we'll be posing to Prableen today. Prableen, thank you very much for joining in. And I believe you have listed out 8 biases for us to cover today. So let's start with the very first one. What is authority bias and how can people overcome it?
Good afternoon, Sumaira. Yes, I think, identifying and knowing these biases is very important to ensure that the financial health of our financial portfolio is maintained as well. So the first one is authority bias. Authority bias is nothing but a natural tendency that we all have to follow a leader. Now, that leader can be a sports person, that leader can be a politician, it can be our elder sibling, it can be a celebrity, it can be a doctor, a guru, anybody. And what happens is that we feel that we tend to give more weightage to whatever they say, and we believe and we pay more, let's say, give more weightage and sort of consider their advice or whatever they tell us with more surety. And I think this is one thing which sometimes inhibits us from taking, very sound decisions. I'll give you an example here. We all know our beloved character Sheldon from the Big Bang Theory. And Big Bang Theory's character Sheldon was used by Intel for their advertisements. And this was done because he commanded that authority. We all felt that, Jim Parkins is the person who is a physicist and who has the ultimate knowledge of, let's say, computers and technology. So that is how advertising and, commercials actually use this bias. And when it comes to real life, we've seen in the recent past a case of a crypto exchange vault, which stopped redemptions or which was not operating, which had issues with their operations. And this was one of the exchanges, Sumaira, which was actually discussed and sort of mentioned by a lot of influencers as well on social media, a lot of people who had YouTube followers. So what happens is when we are in awe of somebody, we somewhere forget to apply any sort of filters while receiving information. So you and me are discussing these biases today. So as your viewers today should also, let's say, apply certain filters and see what actually applies to their situation and then sort of absorb the knowledge. What happens here is that when this is the case, all information that is received sometimes is just taken, the way it is presented, and we take decisions which may not be in our best interest. So I think what is very important here, number one, we need to see that when we are especially taking any sort of a financial advice, we check how credible is the person who's giving us the advice. And what makes, I think the second most important thing is that what is the purpose and what is the incentive of giving that advice? Is it just to gain fan following? Is it just to, let's say, give you real advice, which can go a long way in your financial planning? So I think those filters need to be applied. And this is how this particular bias of authority can be dealt with.
Okay, so question everything, even if you think
Yes.
somebody looks like they know what they are talking about. And,
Yes.
like Prableen said, I wish, you'd go ahead and question even what we're telling you. Don't just
Yes.
take it as the gospel truth. Okay, so Prableen, next we have what you call the consistency and commitment bias.
This one, I think I'll put it in Bollywood style. There's a very famous dialogue by Salman Khan where he says, "एक बार जो मैंने commitment कर दी, उसके बाद तो मैं अपनी भी नहीं सुनता." And this is, I think, it just totally reflects and the spirit of this particular bias. In finance, what happens, Sumaira, and in many aspects of life, we all take decisions. We all have our processes. We have our little commitments. We are consistent in a lot of things because that is how we want to be seen by people, that I am consistent in my performance. I stick to my commitments. But in finance, when this is the case, it can actually create a situation where the person doesn't want to go back and admit his mistake. And a very important example here is of Bill Ackman, whose decision, this was around 2015, whose decision to hold on to Valiant Pharmaceuticals in his hedge fund led to a loss of more than 4 billion for himself and his investors in a 2-year period. Because when all other fund managers admitted that, okay, this is the time to exit the stock, he was the one who went on defending the company and probably his decision to hold on to the stock, and it led to huge losses. So it's very important to, of course, being committed and being consistent is good in life. But it is very important that when even publicly we are mentioning that, okay, this is a fund that I have invested in, this is a stock I've invested in, it's okay, you should sort of lock up your ego. It is okay to go back and say that maybe I made a mistake and I will rectify it, because that is the way to combat it. So the first rule is never say never. Don't say that I will never invest in stocks, I will never invest in real estate. I think these are not good statements. And then when you're taking names of particular stocks or schemes, as a human tendency, we tend to keep defending our decisions. And it is important to realize that it's okay not to defend it and admit your mistakes so that you can move on and at least sort of restrict the losses that that particular asset class, product, stock, or mutual fund is causing. So this one is again very important. And I think this we face in all aspects of life.
Okay, so course correction basically is something that should be done, and even seasoned investors do it on and off. Okay, next is probably one of the biggest biases that we see when it comes to investors, and that is the recency bias, right? The tendency to just look at the very, very near-term news or performance.
Absolutely. And this one on the Behavioural barometer, Sumaira, has seen a huge increase. So the advisors who give data for their clients, they had given the recency bias at about 35%. It was present in investors in 2019. And today in 2021, I mean, the data for 2021 shows that it is as high as 58%. So it's topping the chart on the Behavioural barometer. And of course, it is our tendency to not only view a recent event, recent news, and recent experience. I think we sort of extrapolate it and we just sort of hold on to it. It's something like if I have to go and swim in the ocean, but I saw Jaws the last night, I would probably be reluctant to go and swim in the ocean because I saw that movie where the shark comes and eats the person. So I think it's so important in investing that we are not looking at a myopic sort of a view. We look at returns, we look at asset classes over a period of time. And we have to understand that every year there will be something. In 2008, 2009, there was subprime crisis. Then, the euro debt crisis happened. In 2016, we saw demonetization. We saw COVID. Today, it's something else. So this will always be there. The names change, the problem will change, but some form of problem will always be there. So it's wrong to judge any asset class performance, any scheme, just looking at the last 1 year or 2 years. And with this, what happens is that the promising asset classes or schemes, so maybe we all start, want to sort of investing there. And there's an interesting data. and this is very old, almost 20 years back, in study was done which says that 39% of the new money which went into mutual funds went into the 10% top performers. So I think this was there 20 years back, and with the information, social media, and with availability of information, I think this bias has only increased. So it's important to know, stick to your asset allocation and understand that winners will always keep churning.
Yeah, that's the one true adage, isn't it? Okay, next is this, fear of loss aversion. I mean, why would this be a bias, Prableen?
Yes, this is a paper which said losses loom larger than gains, and this was done in 1979. So again, an old study, and I think, Sumaira, this does tell the truth, because we are all sensitive towards any sort of losses. We don't like to lose things. So, like the paper says, that the pain of losing money is twice as much as the pleasure we can get from winning the same amount or gaining the same amount of money. And what happens is, when this particular bias comes into play, we tend to stick to stocks, we tend to stick to schemes even when they're not performing for a very long period of time, because we don't want to sort of turn those notional losses into real losses and move on. It also happens that when this tendency grows too much, we totally start avoiding certain asset classes which appear risky. So here, I think for investors, it's very important to understand that while we are all looking to avoid losses, losses may not always be very evident. In terms of financial assets like mutual funds and stocks, we are able to see that, okay, a particular scheme is down by 15%. But these losses are not very evident when we come to products like fixed deposits, where probably our purchasing power is depleting and we are incurring a loss in a certain way. But because it is not evident, we tend to create portfolios which are conservative, which are more filled with assets and products where risk is not evident. So it's crucial. Again, this is one of the top 5 biases, and it is as high as 43% seen amongst investors in 2021. So the way to combat it is think of losses beyond what is evident, give time before reacting so that we are not reacting to any loss very suddenly, and then of course follow a process towards investing and stick to it.
Understood. Prableen, we're going to take a very quick break. There are 4 more biases which we hope to cover on the other side, so do stay tuned in. We'll be right back. Hi, welcome back. You're with the special edition of Money, Money, Money. And with us, we have Prableen Bajpai of FinFix Research and Analytics, who's talking about common behavioral biases and how to avoid them. So we've already discussed 4 of these biases. And the next on the list, Prableen, is mental accounting bias.
Yes. So mental accounting bias, Sumaira, is very interesting because I think we tend to differ the way we treat money from different sources. So if I get a tax refund, I'm like, okay, yay, this is the money I'm going to go and shop with. If I'm getting a bonus, I'll say, okay, this is the money, let's go and take a holiday or plan a trip. So money is the same, but we treat it differently when it comes from different sources. And Nobel laureate in 1999 said that money has to be a fungible commodity and should be treated equally. And that is the proper way of how we manage finances. So if we have a budget in place, if we can anticipate what kind of money will come to us during the year, be it your bonuses, be it your tax refunds, and then have a plan in place, we can better utilize this money because part of it can go into probably repaying of debt. Part of it can go towards fulfilling our financial goals, investing in a certain way. And of course, part of it can always be left out, for a certain amount of shopping and the extravagance that we want to do. But treating that money totally differently and not including in the overall setup, I think that's a big mistake and that should be avoided.
Okay. What about familiarity bias? I know we're often told that, invest in things which you can understand, right? So which is the stocks or funds that, you're familiar with. Why would this be a bias?
Familiarity bias is like your comfort zone. It doesn't let you grow, Sumaira. So it's like going to your old friend always and not trying to make new friends. So familiarity bias restricts us because we tend to invest in, let's say, stocks or a particular fund or a particular fund house or a particular product which we are familiar with and feel comfortable with. It actually has less to do with knowledge. It has more to do with our comfort with that particular product. And whenever we need to invest, so that particular asset class, let's say people who have been investing in real estate say, okay, real estate is the go-to asset when I have money. So I think this needs to be sort of broken, this bias, because it leads to, concentration risk. There is less diversification, and then the risk management is never proper in the portfolio. And as we age, I think our tendency to sort of stick to things we are more familiar with increases, and that is why it's seen more in, the elderly generation of investors. So the idea here is to start small, to make yourself familiar with new asset classes, gain knowledge, and then set goals and see how it is achievable. And that is the way that we can actually decide what and where we should be investing.
Okay, so basically invest in things which you know, but continue to keep increasing the scope of asset classes or investment classes where you have familiarity. Start small and then build on that. Fair enough, Prableen.
Yes.
Okay, next, what is confirmation bias?
Confirmation bias, we all love to be told that I'm so right. And confirmation bias is just that. We keep looking for information. We keep looking for any sort of, a news extract or something otherwise, which can sort of confirm or which can, again, endorse our beliefs. If I feel that the markets are going to be choppy, I will keep looking for information which sort of will, substantiate it that, yes, what I'm saying is right. If I say that, real estate is not the asset class to go to and it may not really increase, then as a person, you start looking for information which confirms that belief. So our tendency to keep looking for information, that is what confirmation bias is. And this, again, restricts us as an investor, Sumaira, because we make judgments based on our very, strong beliefs. And we are not very ready, sort of open to experiment or move out beyond those beliefs. So here, I think the role of an advisor becomes very important because only with communication and data, which is probably contrary to an investor's beliefs, can he or she be convinced that, okay, I am fine with maybe, moving out and looking beyond what that person strongly believes in. And this is how the confirmation bias can be probably dealt with. And this is, again, one of the top 5 biases by the Behavioural Barometer.
Wow. So basically look and appreciate and welcome contrarian opinion. At least, you know, hear out the other party before you take a call, right? Okay, the final one on our list is framing bias. This is not really from the investor's point of view, right?
No, it is from the investor's point of view, Sumaira. Again, this one has seen a huge increase. It was at 17% in 2019, and now it is at 44% in 2021 by the Behavioural Barometer. So if I say that there is an 80% chance that an IPO on its listing day can go up by, you know, the stock price can go up by 40%, that is one way of presenting the information. And if I say that there is a 20% failure chance that the IPO, when it's listed, it may not go up by that amount. Now the information is the same, but the way it is presented is different. And the way information is presented, this really changes our perception towards an investment product. It changes the perception towards a situation in life. You know, optimism brings in, let's say, more positivity, and people are ready to take chances. And this is what happens in the bull markets. We've seen maximum IPOs, maximum NFOs when the markets are good, and it's easier for investors to be convinced because a story can be presented in a certain way. And framing bias is used not only in finance, it's used in marketing, it's used in you know, other aspects as well by marketing teams and commercials. And one of the ways, it's very hard to sort of guard yourself against the framing bias. But again, I think just asking and challenging that, why am I doing this? Even if you're influenced by something, can probably reduce the damage. So it sounds really good, and, you know, information is presented in a great way, but it's important still to challenge the information so that you can have, you know, sort of a view which may not be confirming or in sync with what has been told to you. So that can reduce the damage. Otherwise, I think, again, we are all victims of framing bias to quite an extent, and we don't even realize it.
That's true, Prableen. In fact, the problem is that we may not realize that we're acting with a certain bias, and that was exactly the objective of this chat, which was to, you know, let you know that there are biases which are prevalent perhaps within us and around us, and the objective was to familiarize people with what they are and therefore how investors can recognize them and overcome them. So basically training your mind just like you train your body. Prableen, thank you very much for joining in. We'll wind up on this special edition of Money, Money, Money. Thank you very much for watching.